The profit split method is a transfer pricing method for determining whether the allocation of profits between related parties adheres to the arm's length principle. It is especially useful in cases where related parties are engaged in highly integrated business activities and where both parties contribute significant value to the transaction. Unlike other methods that focus on pricing specific transactions, profit split method allocates profits based on each party's contribution to the generation of profits. This video will explore the key principles behind the profit split method, including the distinction between the pure profit split and the residual profit split approaches, and the circumstances in which each method may be appropriate. The profit split method operates by dividing the combined profits, or losses, from a controlled transaction among related parties based on each party's relative contributions. These contributions are assessed through a functional analysis that takes into account the functions performed, risks assumed, and assets employed by each entity. There are two main types of profit split method used in transfer pricing: the pure profit split and the residual profit split. Both approaches involve sharing profits, but differ in how they allocate profits and assess the contributions of each party. The pure profit split method divides total profits, or losses, earned from a controlled transaction based on an agreed-upon allocation formula. This formula is derived from the relative value of each party's contributions to the overall profit. Typically, contributions are measured based on certain objective factors, such as labor costs, time spent, market risks borne, value added. In this approach, the profits are shared proportionally to each party's role in generating the profits. The pure profit split method is most appropriate when both parties contribute equally significant value, such as in joint ventures or partnerships where both entities perform complementary functions or share critical intangibles. The residual profit split method differs in that it first allocates a routine profit to each party involved in the controlled transaction. Routine profits are the returns that could be expected based on the functions and risks typically undertaken by each party. These are usually determined by reference to comparable transactions between independent parties. Once routine profits are allocated, the remaining profits, the residual, are split between the parties based on the relative contributions of each to the residual value. These contributions usually involve non-routine intangibles, such as intellectual property, unique assets, or proprietary technology. The residual profit split method is often applied in industries where significant intangible assets play a key role in value creation, such as the technology or pharmaceutical sectors. The profit split method is typically used in the following scenarios: highly integrated operations, when the controlled transaction involves highly integrated activities where both parties contribute significant value to the transaction. Intangibles and proprietary knowledge, when both parties bring unique, non-routine intangible assets that contribute to the profits. Joint ventures or alliances, in cases where two related entities share the risk and rewards of a joint enterprise. The method is particularly useful when other methods, such as the comparable uncontrolled price or the transactional net margin method, are not appropriate because of the complexity or uniqueness of the transaction. Nature of profit sharing. In the pure profit split method, profits are allocated entirely based on a predetermined or negotiated formula that reflects each party's contribution to the transaction. This can be in terms of tangible assets, risks, or other factors deemed relevant. The method assumes that all the profits or losses can be attributed directly to the shared contributions of the parties. The residual profit split method, on the other hand, first allocates routine profits, which are calculated based on benchmark data from independent entities. These routine profits are typically based on the typical return one would expect for performing routine functions such as contract manufacturing, distribution, or administrative services. The remaining profits, or the residual, are then split between the parties based on their respective contributions to intangibles or other non-routine assets. Pure profit split is most appropriate when both parties contribute symmetrically or in equal measure to the overall success of the transaction. This may be the case in strategic alliances or joint ventures, where each party shares equally in terms of capital, risks, and operational input. Residual profit split is better suited for situations where one party performs routine functions and the other contributes unique, high-value intangibles. This method is common in industries where intangible assets drive profitability and where the routine returns need to be separated from the exceptional profits generated by proprietary technology, patents, or brand value. The pure profit split method tends to be less complex, as it applies a formulaic approach to dividing profits. However, determining an appropriate allocation key, such as relative value of inputs, can still require careful judgment and justification. The residual profit split is generally more complex due to the need to determine an appropriate routine return for each party, followed by the allocation of residual profits. Additionally, splitting the residual profits often requires a deeper analysis of the non-routine intangibles and the contributions they make, which can introduce subjectivity. The profit split method is a valuable transfer pricing approach for multinational enterprises engaged in complex, highly integrated transactions. While the profit split method offers flexibility and fairness in profit allocation, it also presents challenges, particularly in terms of subjectivity and data availability. Businesses applying the method should be prepared to justify their profit allocations and provide robust documentation to support their approach.